What's up, everyone? It's Caddy with Money Investing. Welcome on board for another Market Open live stream. We've got lots to unpack. Jerome Powell is going to be here in about less than an hour. So his testimony in front of the U.S. Senate is going to begin at 10 a.m. Eastern. Pre-market, we are pulling back a little bit. So you'll notice Google is slightly down. Apple slightly lower. Tesla is down another 1%, down to 191. And Microsoft is slightly higher, with QQQs overall pretty flat, and we got SPY very, very flat, with the Dow Jones also really flat at the moment, and we got the 10-year yields down about 45 basis points. If you guys can see me, hear me, just give me a thumbs up in the live chat. I just want to make sure the audio and the video is working well, and welcome on board. Welcome on board. We've got big 2 days of meeting from Jerome Powell, and we're going to be focusing on what analysis or what type of color he provides on interest rates, inflation, unemployment, and GDP. So those are going to be the four key takeaways from this testimony, and these can last, long hours. So hopefully we get some good questioning from the Senate members and the members from the U.S. Financial Services Committee as well. So make sure that you drop a like. Right now we do have the Market Open poll going on, but eventually we're going to switch over to Jerome Powell's testimony, whether you believe that whether Jerome Powell is going to be more hawkish versus dovish. So we'll kind of flip that over to that poll once the market's already opened. But volatility right now is slightly higher, up over 1.45%, so getting up to over 18.8, almost 19 levels. And we do have the crude oil prices also rallying back up to over $80 a barrel, getting up to that resistance right now, once again, sitting at low 80s for crude oil. Bitcoin, on the other hand, just consolidating sideways ahead of this testimony, and Ethereum also just trading sideways here, getting a little bit of a rejection at those lower highs, coming in at 1700. So once again, from a crypto standpoint, it's been mostly risk on in 2023, but more recently in February and after February, we have seen a little bit of a risk off environment for the markets, of course, as yields have continued to push back higher. So yes, we'll take a look at SE earnings as well. Kevin, I'll take a look at those earnings, but we do have lots to cover. And again, SE is reported pre-market. We got Dick's Sporting Goods, Squarespace, and then CrowdStrike is going to be reporting later today. So later after the markets close. And then later this week, we've got JD.com, we got BJ's, DocuSign, Ulta, Gap, Oracle, all those companies. And this is the forward implied volatility, which we talked about in our yesterday's market update. Again, shout out to our members over in Discord for sharing this. And the implied volatility on a forward basis did suggest that we could rather see volatility get up to over 22. And right now we're trading at just a little bit under 19. So that could be a pretty decent spike in the VIX of 17-18%. Of course, considering if Jerome Powell is super hawkish today, right? And of course, we got payrolls 26. That's the unemployment Friday by March 10th. And then CPI, we could see it up to as much as 32, and then FOMC 36. Those are pretty extreme levels for volatility on a forward basis, implied volatility here. And of course, only time will tell if this is actually going to happen or not. So again, Jerome Powell, 10 a.m. Eastern. We got wholesale inventories coming out also at 10 a.m. Eastern, and we got consumer credit scheduled for 3 p.m. Eastern. And then tomorrow, Wednesday, we've got Jerome Powell once again. We got the Beige Book, and we got the ADP non-farm payrolls numbers and JOLTS coming out at 10 a.m. Eastern. So pretty big employment week, so labor week pretty much, and unemployment situation is going to come out later this week on Friday, March 10th for the United States. And this is the consensus, 175,000 jobs added in the month of February for ADP non-farm payrolls. JOLTS to come down to 10.6 million openings. Now, this doesn't necessarily mean that we are seeing more and more people kind of occupy those openings, but this could also mean that job openings are going away as companies are not hiring anymore. So this can be, again, both of those things. Doesn't necessarily mean if those numbers come down, that means that there's fewer job openings because people are getting hired more. But it could also be because companies are not hiring anymore, so there's fewer job openings to begin with. And this is going to be the employment situation, with the non-farm payrolls expected to increase 215,000, with the unemployment rate to stay steady at 3.4%. And private payrolls at 213,000, with the average hourly earnings to increase 0.3% month over month, and 34.6 hours of the average work week in the U.S. in the month of February. And consumer credit expected to balloon up another 26.4 billion in the month of February. And actually, this is going to be for the month of January. So this is going to be a little bit more of a lagging indicator for the consumer credit market. But we already know that the credit cards and everything else is sitting well over $1 trillion, mortgage debts over $11 trillion as well. So, good morning, everybody. We've got lots of spreadsheets, everything that I've already gone over in my previous videos. I figured, I'd just go over that in our live stream as well, kind of, really go over some of the data and some analysis and some facts. And we'll talk about it because we're going to be here for a long time, at least a couple hours until, Jerome Powell's pretty much done talking. Can't make any promises if I'll be here for like till the end of it, but we'll cover majority of the testimony from Jerome Powell. Now, talking about SE, C Limited, so they reported earnings pre-market. Right now, they're gapping up over 7.8, almost 8% here. So let's take a quick look on their numbers. So they do swing to a profit, which is actually a good thing for the Southeast Asian company. I have done some analysis on them before, but let's see what the numbers look like. There we go. So C Limited shares up more than 11% pre-market after Singapore tech giant reported fourth quarter results that blew past Wall Street expectations. So they reported an adjusted 72 cents per share and revenue rose 7.1% year over year to $3.45 billion. Analysts were expecting a loss of 55 cents and a revenue of $3.05 billion. So we got a double beat. And the company also generated $948 million in revenue from digital entertainment in the period, up from $892 million same time last year. Let's see if you have any guidance here. Doesn't look like we do at the moment. And $2.1 billion revenue from its e-commerce division and a rise of 31.8% year over year. That's a pretty good growth here. That's considering consumer continue to flock to its Shopee platform. So those are pretty good numbers. Double beat, stocks pushing higher. However, I think the valuation is still a little bit too expensive here. Maybe not so much. 3 times sales. And we don't have a price to earnings, of course, because the company's not been profitable and price to cash flow is also non-existent. And we also don't have enterprise value to EBITDA. But I guess for an e-commerce company, I think 3 times sales, even 3 times sales is a little much. I mean, Amazon, Walmart, they trade at 1, 1.5, under 1 sometimes, price to sales multiple. So for this company, 3 times does seem a little bit on the higher end. What type of margins are we working with here? So gross margins are sitting at 39%. And we got operating margins of negative 17, 18%. So yeah, I think 3 times sales is a little bit expensive here, Kevin. But support level, very strong support here in the $45 to $54 per share level. And resistance is going to stay put at $93, $94 per share. So what do we got? Let's see. Milan says Jerome Powell going to get spanked today. We'll be able to look at NXT, its new IPO solar stock. So we'll take a look at that company as well. Alex has bought C before earnings and happy with the results that accelerated uptrend on today's JP pump. So that's good. Congratulations on the profit here. And on average, if you take a look at how the markets have performed, and again, I did a video about this yesterday, talking about how during those testimonies, Jerome Powell's testimonies, and this is when Jerome Powell has been the chair. So and how the markets have performed. So on average, it's been a bit of an uneventful day. Only 0.06% gain, which is literally just flat markets. And the biggest gain happened in 2020 when it was up 1.9%. This is S&P 500 we're talking about. And the biggest loss also happened in 2020 when the markets were down 2.37%. This is again S&P 500 and the median gain of 0.18%. So, biggest loss, a lot more than the biggest gain. But on average, markets have been a little bit more leaned in towards the bullish side for the day of those testimonies. So again, today we'll see what happens March 7th and March 8th, 2 days of testimonies from Jerome Powell in front of the U.S. Senate. And of course, not to mention 2022. All right, I just got to update that. Thank you for pointing that out. 2023. There we go. Yes, March 7th and March 8th, 2023 and 2023 for both of those. Yes, so we'll see what today has in store for us for the market. But we are seeing a little bit of a pullback pre-market. So Tesla is down over 1% right now. My calls are now up over 77%. So a few more percentage points. I'm looking for like another 13% and 90%. I'm happy to close them out for profit, and then I'll just sell new ones with maybe a little bit of a lower strike and slightly lower expiration. Maybe not so much for the premium, but we'll be looking at hedging Tesla stock even further down. If it continues to drift lower, then of course those calls are going to be worth more as time goes on, as they could move further out of the money. So Yeah, so biggest gain and loss were also in September after the markets overextended that in August. Yeah, so September usually has been, one of the most brutal months in the market seasonality wise. So it doesn't, obviously with September being the worst month, volatility is super high. So it's normal to see biggest gain and biggest losses both in the month of September, obviously because of how much volatility there is and because of how much markets move up and down during that month. March historically has been a bullish month. So if we come over to some seasonality analysis, and take a look at how the markets have performed over the last 46 something, or no, 50 something years, might be even more, 70 something years, 72 years since 1950s. March, you'll notice that 46 up years and 27 down years with an average gain of about 0.92%. When you compare that to September, 32 up years and 41 down years. Can you believe that? Since 1950s, September has been down 41 of those 72 years. Absolutely wild. And an average decline 0.8%, but some of these Septembers have been absolutely brutal. 2022, we were down almost 9%. 2021, 4.89%, 2020, 4%. So in the last 3 years, 2020, 2021, and 2022, and yeah, so those last 3 years, September has always been red. Always. Down at least 4%, if not more. If you average these two out, 20 divided by 3, we're looking at least a 6% decline for September in the last 3 years. September is definitely brutal. But March, in comparison, is obviously a lot better. We're looking at only 0.92%. 2020, we pretty much saw a 13% decline, but last year, 2021 and 2022, pretty modest gains, 3.3%, 3.8%, both of these months in the last couple of years for the markets. So we'll see what markets have in store for us this March. So yeah, let's see what ends up happening. I'm gonna keep that poll going on for now, but we'll switch over to Jerome Powell's testimony and then whether he's gonna be hawkish or dovish today with his speech. And we got about 7 minutes left for the markets to open here, so it should be interesting whether the markets get bid up or if he continue to trade sideways until after Jerome Powell takes the stage. I will do a quality check once this starts running. So I just want to make sure the audio is working. So I'll do a quality check and then I'll turn this microphone off so we can listen in together on the semi-annual monetary policy report to the Congress. Man, it's grilling season. That's what it is. It's literally grilling season. Jerome Powell is going to get grilled. Sometimes it does get pretty funny, to be honest, with the line of questioning. All right, so hope you all are ready. So, well, boys, Caddy, do you think there's still a possibility of new lows? And as such, the October lows are not the lows, as some people like Tom Lee say that October was the bottom. Well, again, yeah, we talked about the analysis from Tom Lee, and it's kind of, I'm glad that you bring that up because it's not perfect, because obviously he's painting a bit of a bullish picture, and there's nothing wrong with that, right? If you believe in this technical bottom here, that's totally fine. But I do if you're asking yourself the real questions, right? Objectively, if you think about 2009 and if you compare that to 2023, I mean, you're going to find a lot of differences as to why the markets bottomed in 2009, right? I mean, obviously, this was in March of 2009. He shared this chart and pretty much mentioned that, 5 months after 2009 lows, markets rallied and everybody was talking about it being a sucker's rally. And it ended up being an actual rally and those stocks kept on, drifting higher and higher. But the problem is that in 2009, I mean, we were pretty much at the higher end of that unemployment curve. Like we were pushing higher. And I was looking at that today. I was like, okay, March 2009, where was the unemployment rate? So if you go over to the unemployment rate from BLS, and if you scroll back to 2008, around here, if you take a look at where we were back in March of 2009, we were at 9% unemployment. And then it was pretty high already. Like it already had rallied, from lows of about 4.3% to almost 9%. That was a 112% gain for the unemployment rate. And then over the next few months, we kind of drifted higher a little bit. In October of 09, it was at the highest at 10%, and then it started to roll right back down. It kind of drifted lower. But the problem with that situation or that analysis is that the market's a forward-looking metric, right? The market's looking, 12 months, 24 months out. So by the 2009, most of the recession and the higher unemployment was most of it. I'm not saying all of it, but most of it was behind us. And the Federal Reserve had also started to cut rates to support the economy. In 2023, it's completely different. The Federal Reserve is not cutting rates; they're increasing rates, and at the same time, unemployment is still low. We haven't really seen a economic recession in the U.S. So I can't make that prediction whether the lows are in or not. All I can really understand is what's going on in the economy, and does that pose a risk to the markets right now? If you ask me from a risk reward standpoint, unfortunately, I will tell you there's from an upside standpoint, there isn't a lot of upside left considering what I know, and there's a lot more potential downside here. From a risk reward standpoint, the market's not looking super attractive at these levels at 4,000. So that's what I would say. Whether we come down to October lows, really depends on whether we see a recession or not, right? If there's a recession, which many people are saying inevitably will happen, and I'm also leaning a little bit more towards there is going to be a recession with all the indicators that we're seeing, but then it just comes down to how brutal it's going to be. So unemployment rate calculations were changed right before 2008 election, so the numbers aren't comparable. So even if they're not comparable, how much of a change are we looking at, right? The logical thing really is for unemployment to be calculated in a way that you understand, okay, how many people are unemployed in the US? And right now that number is sitting at just under 6 million people. And then what's that participation labor? In other words, how many eligible workers are there? 266 million. And then all you really do is that participating population of eligible workers, right? 166 million. And then you just calculate that unemployment rate, right? That's the most logical way of doing it. It doesn't matter if you kind of switch around, how we calculate participating labor, participating population, all things said and done. Back in 2008, we kind of peaked out at 10%. Right now we're at 3.5%. So it's, I think some of those things I can definitely, be considered as cherry picking the data from Tom Lee, unfortunately, but I do like the technical momentum behind the rally that we're seeing. Definitely does suggest that this is definitely going to hold up and we're going to keep pushing higher. But to say that comparing 2023 to 2009 seems a little bit of a stretch, in my opinion. I don't know what you guys think, but so what do you think about Meta? So Darwin, yes, I had a video literally posted about Meta just about an hour ago. Make sure that you do check that out if you can. So Esther, what would your stop loss be on the Google trade you suggested? So Google's already moved up quite a bit from that buy target. So I would definitely move up the stop loss now. I would keep it at the low of yesterday's candle. So for example, your low of yesterday's candle was around $94.30. So sub $94 would be that stop loss now. Definitely lock in some profit. So you want to move up your stop loss so you're not giving up on some of the gains that have already happened. So it really depends. Obviously, if you're entering now, the risk reward has definitely shifted quite a bit. Earlier, we were looking at, risking about 2% for an upside of 19 to 20%. So this was a pretty good asymmetric, high risk, high reward, low risk trade. But so if you entered from previously, then definitely at the low of yesterday's candle. But if you're entering now, the risk reward definitely has shifted quite a bit. So you definitely want to be careful with that. Anyway, the market's about to open. We're going to switch over to the S&P, the NASDAQ, and the Dow. The yields are back over 3.96%, and as a result, TLT is slightly pushing higher right now pre-market, but still coming down to those lows at around under $99, $98 per share at the moment. So Alex says buybacks will pump earnings, EPS, that will trigger a new rally. Well, hopefully that's the thesis, right? But buybacks will eventually end somewhere, right? Companies can't keep buying stocks left and right. Eventually they'll run out of cash and they'll have to actually show some real growth in net income. If they don't, well, then we're going backwards. Anyway, NASDAQ open, flat open here on the day. We got the S&P opening flat as well, just a little bit over 4,045. Less than 30 minutes left for Jay Powell to take the stage for the U.S. Senate, in front of the U.S. Senate for his testimony. And we got the Dow Jones here pretty flat, and the yield is jumping right back up to over 3.9.5%. Tesla gapping lower, down about 1.3%, under $192, sitting just over 191. We got Microsoft flat, we got Google here flat, Apple flat. So pretty much everything's just straight up flat right now. We're not getting a lot of momentum intraday at the moment. Meta is up 2.7%. So I did a video on Meta earlier. Make sure that you do check that out. Did a complete analysis on why the stock's pushing higher, what could be the game changer for Meta moving forward with artificial intelligence, and then going over the fair value, the intrinsic value with the growth rates, expected growth rates for the company. So you definitely want to check that out if you're interested in Meta. Wait, Haas, no way. Are you serious? Southern Copper, SCCO? Are you really serious? Man, congratulations. I can't believe you're up 58% from that video. That's crazy. Wow. Wow, that's incredible. Yeah, we did a complete detailed analysis on this company not too long ago. I did a complete analysis on the copper supply in the US, and then we also talked about SCCO. It was one of the best companies out there for copper mining. Copper is another, metal, like pretty much a commodity which is very much in need, and the supply is also not that abundant. So we did an analysis on this company, and man, I can't believe we're actually up 56% on that, 58%. That's incredible. Congratulations. And they also pay a dividend, so that's phenomenal. Happy for you. Happy for you, sad for myself for not taking advantage of it, but hey, it is what it is. Lauren, that's great. Congratulations on that. Any comments on NRG? So let's take a quick look. NRG Energy. So lots of consolidation sideways, and we got 4.39% yield as you'd expect from an energy company, consistently growing revenues in the last couple of years, of course, because of prices in energy sector. Earnings have unfortunately not grown. So that is quite interesting. I mean, a lot of energy companies that they have been able to consistently grow revenues, but also cash flows and earnings as well. And speaking of, I was actually looking at some research earlier. I'm definitely looking at potentially corporate bonds issued by energy companies, because they offer high yield because of how risky they've always been perceived to be. But the risk has been a little bit off the table considering how much cash they have available and how improved their balance sheets are at the moment, given how high energy prices have been over the last couple of years, if that makes sense. So I was looking at a couple different ETFs that do offer high yield corporate bonds in energy sector, and we're talking 6 to 8% dividend yields, and of course exposure to some capital appreciation over time. So maybe I will be doing a video on that as well. Just been doing some other types of analysis where the risk might be a little bit lower and there is potential for reward, whether it's corporate bonds, government bonds, and maybe some bond price ETFs that trade off the run, on the run, rebalancing every single month. So lots of different types of analysis and videos will be coming out. 56%, that's great. That's awesome. Do you own any Rumble shares? Yesterday it ran up 20%, so nope, don't have any Rumble shares, don't plan on buying either. But for NRG, would keep a close eye at around support at $30. I'm kind of curious to learn more about this business because of the revenue growth, but not really the earnings. Earnings are pretty flat, and it's trading at a really, really low P multiple, low enterprise value to EBITDA, and we've got pretty low. I don't know why my Siri is going on. What is going on, Siri? All right, you can. There we go. Okay, I don't know what was happening there. Stupid AI can be helpful, but it can also be a pain sometimes. Yes. Please do a video on the bond ETFs. With Tina gone, we need to diversify. Yes, so I'll definitely be doing that. I think there's a lot of potential there, and I don't think a lot of investors kind of realize what's going on. And I tried to do a video on this, risk tied versus risk free. And, this is really, I mean, if you think about what a rational investor would really do, it is, the fact that the 1 year and the 6 month, and even on the 2 year note, right? If you're looking at the short end of the curve, which is 2 year, 1 year, and 6 month on the US treasuries, all of them are paying you over 5%, right? So you've got 6 month 5.18, 1 year sitting at over 5%, and 2 years just a little bit shy of 5%. Even 3 month is 4.9. So short end of the curve, there should be a lot of fight for liquidity because of how high these yields are. I mean, they're literally competing, not even competing, but they're paying you more than the dividend yield on the S&P, the earnings yield on the S&P, and the cap rate, the average cap rate on real estate. So the premium has really diminished in the last couple of years. So there's a lot of opportunity, especially on the long side of short duration bonds, for absolutely no risk. No risk. The only risk really there is the U.S. defaulting on its debt, which again we've had that those concerns kind of resurfacing a little bit. If the debt ceiling isn't raised, then the U.S. will default on its obligations to pay its creditors. But I don't think that's going to be a problem. I think Jerome Powell is going to talk about it today, where obviously the government needs to kind of raise that debt limit once again, as they keep doing it, right? Raising the ceiling to borrow more, to spend more, and keep, of course, digging that fiscal deficit more and more. So I don't see that as being a problem. Again, we talked about how technically the U.S. did default in the 1970s once, but that was only just being late on their payments, and that's about it. Other than that, the U.S., again, AAA rating, it's one of the most credit-worthy nations out there, next to some of the other ones that we've also analyzed. Milan says, "Be nice, Caddy. AI can hear you." Yeah, I don't know why it started. I didn't even say, what you're supposed to say or to activate it. But anyway, so markets getting a little bit of a lift on the back of Google here, 30 basis points. We got Apple also pushing higher, but mostly flat. And we got Microsoft here up over 16 basis points, with Meta up over 2%, kind of leading the day among big tech. And then we got, wow, TWKS, don't tell me. Do not do this to me. Everybody who's in our Discord, what did we talk about this stock? What did we talk? Oh, Kevin, do you remember? Posted a chart and an analysis on this. That this could easily be a dead cat bounce considering how oversold it was. And they actually reported some good numbers. They reported fantastic numbers. Great earnings. Because what happened really was when they reported numbers, their quarterly guidance was not great. They actually missed on their quarterly guidance. But they beat on their yearly guidance. So I was kind of confused. I was like, why is this stock selling off on the fact that it's trading at really low P multiples? The last time I checked, it was closer to like 16, 17 times earnings. And their entire yearly guidance was so strong. It was, it didn't make sense. So I mentioned it, in the Discord, kind of sharing the chart and the analysis that this could definitely be on watch here, considering how oversold it is now, because on that week it was down 17%. Actually, on the week it was down a little bit over 14% on that day. On the earnings, it was down 17%, sold all the way down to 650, and boom, pushing right back up. Massive gain here of 29-30%. Then we got Snapchat here. We got Roblox, Spotify pushing higher, and then let's see which ones are red. So Neo, JD.com, we got Baidu, Tencent down about 2% each. Walgreens, InMode, flat. So not a lot of momentum here intraday, except for this company here, ThoughtWorks, and then some of the big tech companies. So among energy companies here, everything's red. Oil prices are rolling over a little bit, so we got pretty much everything down at the moment. Then we got banks pretty much selling off, except for MasterCard, HSBC, Square, PayPal, slightly higher. So what we're going to do is we're going to end this poll, 51% expecting the markets to be green, but we're going to start a new poll asking Jerome Powell's tone. Jerome Powell will be ... hawkish, dovish. That's about it. That's what we're going to keep. Jerome Powell. Today, Jerome Powell will be hawkish or dovish, right? In his tone, right? Talking about inflation, interest rates, and how he's going to keep fighting for it, or if he's going to be more about, disinflation, and we're going to think about a pause, or sheepish. Or Impish. Anybody? Any references? Anyone remember what impish is? Only a certain few will get that reference. So when is Jerome Powell speaking? He is going to be talking at 10 a.m. Eastern, so in about a few minutes. So yeah, he's gonna be on in about 18 minutes or so, 19 minutes or so. And what I'm gonna do is I'm gonna make sure to reload this page. We're gonna again do a sound test. Just want to make sure that everything's working well. Oh, Ray says The Office. Ray gets it. Ray gets it. Ray. Yes. Yeah, he is going to be frustrated a little bit with some questions. Can't speak for all. But yes, I think the reason why these meetings are a lot more important, I think, in my opinion, than FOMC is because they're longer and they give you more context, right? They go into a lot more detail and, they're more data driven, right? These questions are longer. They're, going over they're directly asking Jerome Powell certain questions. They're not backing off. So I like these way better than the monthly or the every other month FOMC meetings because those can tend to be like really, really frustrating because you're asking, some of the more surface level basic questions and you're only asking for like, getting 30 seconds to answer, to ask your question. That's about it. But I think these are a lot more fun to watch, a lot more interesting to watch. Yeah, markets will swing wildly. It's possible. I mean, we're already starting to see S&P come down a little bit. Nasdaq still holding up pretty well, but Microsoft's rolling over. Tesla's pretty flat, still down about 1%. And yeah, Snapchat here, Twilio's pushing up. CrowdStrike pre-earnings has definitely made quite a dent on the upside. I would definitely be very careful after the earnings, considering how overbought it starts to seem now. We've got a bit of a gap to fill. And this is a gap from like December of 22. So keep that in mind for CrowdStrike as well. So 61% right now, suggesting hawkish. So Varun, Kadisha, sell C3AI stock or wait. So Varun, I'm going to need more information than that. We talked about this during our live stream. About a potential symmetrical pennant or like a symmetrical triangle or like a bullish pennant, so to speak. It had a very strong breakout here, another 33% gain. I mean, it's also one of the stocks that's heavily shorted, but the next resistance and target for C3AI really sitting all the way up here at 53.25. But, it got really overbought, started consolidating, had a really good breakout past this level. And right now we're kind of fighting this resistance again. At $29.55, closer to $30. So you'll notice that we are kind of struggling to actually break out above that level at the moment. So that's the one to keep in mind right now. So volatility just a little bit subdued, under 19. And Tesla here really just consolidating sideways at over 191. So it hasn't really picked much of a direction at the moment, just really trading inside that potential bull flag. So we'll see if any buyers step in from those levels. This is the bull, this is the flag, or that's the pole, that's the flag, and a potential breakout can really take us north of 250s for Tesla if we get high volume and high breakout. And Tesla also kind of cutting their prices again on a few of their models to kind of stoke their demand. Yeah, 140, 150 is kind of reasonable levels for me too, for Tesla. So we'll keep that in mind. So First Solar, let's take a look. Let's see what's going on with that stock. Oof, look at this, 2.2% other gain here, pushing up a little bit over 34%. Wow. So really, really strong earnings. Well, not so strong, still reporting a negative earnings per share. Revenue came in line, but definitely there's a lot of momentum for, of course, renewable energy, solar panels, all those types of companies. Prime example is Enphase, but now it's starting to trade at, First Solar is starting to trade at 9 times sales, which is pretty crazy to think about. By the way, Enphase, we also had a bit of a trade idea. It started to push right back up, pretty good. So another 4.43%. Yesterday was up almost 4%, so pretty nice gain on Enphase as well. Damien, thank you so much. I really appreciate comments like these, man. I really do. So thank you so much. I really appreciate it. So Varun, Caddy, what should be the best time to buy a house in 2023? So really, I mean, what you want to look for is that intersection when interest rates are rolling over and house prices are also down. So that happens, not for a super long time because, of course, interest rates, as they come down, prices eventually do end up moving higher because of that increased activity. But you want to look for that time when house prices, I mean, right now, we're already starting to see mortgage demand plummet down to a 28-year low. So people are not really looking for mortgages at the moment. They're not looking to refinance or not looking to actually buy a home and lock themselves into a 7% mortgage rate. So if demand starts to kind of peel off a little bit and you see the supply increase slowly and steadily, whether it's, properties coming back on the market or people just selling their properties. So whatever the reason might be, if we see a pullback in home prices, you really want to look for that intersection where prices are down 20, 30, 40% from their peaks. And at the same time, you're able to finance it at lower rates. So you definitely want to wait for the Federal Reserve to give you the green light. And once inflation is under control, they will most certainly try to support the economy the best they can by lowering interest rates. So that intersection there, I think, is going to be the one to look for. Yeah, so that's kind of like my 2 cents. That's what I would be waiting for if I were, definitely in the market for real estate. So has TLT bottomed for 2023? It's kind of a difficult question to answer. What you're really asking is, has the 10-year yield topped out in 2023, right? So short answer is, I don't know. The long answer is we can speculate. We can obviously try to understand what's going on with the 10-year yield. And the yield going higher is just the market's indication that there is concerns over the economy. There is concerns over inflation. Expectations are coming down a little bit. They're deteriorating as the yield's going higher. And what's really interesting is that the correlation started to kind of break apart in 2023, that even though, well, not so much in 2023, more specifically in February, because as the yields were pushing higher and they pushed up 20% in the month of February and going into March, the S&P 500 kind of held up a lot better, right? It still went down about 6%, but definitely it held up a lot better than what we have seen in the past. I mean, a 20% move in the yields should have easily brought a lot of downside in the markets, especially the Nasdaq. The Nasdaq went down since the beginning of February, went down about 7%. So I guess that's reasonable. But we did see a little bit of that correlation break apart because we did see a lot of volatility in the market, right? Lots of indecision. But if you guys remember, I shared a chart in our other video where talking about the yields with respect to the markets and how there's been a very clear inverse correlation between the two, where when one of them goes up, the other one goes down. So you can even see it over here. Every time we see the 10-year yields kind of push higher, that's the cue for the markets to come down. So this has happened since February. Yields have pushed up 23%, and of course the markets have come down 8.7%. As since December, the yields pretty much rolled over, and they dropped about 14%. Since December, you'll notice the market pretty much rallied about 19, almost 20%. So that's the inverse correlation. Then you can once again see a drop in the Nasdaq, about 11%. This is the jump in the yields, 14.5, 15%. So that's the inverse correlation. As yields go higher, valuations compress. Growth stocks definitely do get hurt more than value. But the 10-year yield, I mean, if the Federal Reserve keeps hiking rates, and right now it's priced in about closer to 100 basis points or 1% till July of 2023, I could easily see the yields tap out to 4.5, 5%, or even higher. That's why I'm not kind of building out my entire position on TMF. I'm a little bit more, patient with building out my entire position on TMF, and then eventually kind of sizing up, and kind of going to a point where I do believe that, okay, now the 10-year yields have tapped out. The Federal Reserve is kind of pulling back on interest rates, so we can start to see the yields roll over and TMF, TLT to push back up. So that's the game plan with the bond market. So CrowdStrike earnings, Marcos. So we can go over what the expectations are. Um, but right now I can tell you, like from a technical standpoint, it does seem a little bit on the overbought side here, but the consensus at the moment right now is about 43 cents per share. Looks like they are turning the corner towards profitability with $625 million in revenue expected. I did a video on cybersecurities not too long ago. Literally last week, we talked about, 5 cybersecurity companies. So you can pretty much get a good analysis on all of them. We talked about Fortinet, Palo Alto Networks, CrowdStrike, Okta, and Zscaler. So all 5 were covered in that same video. So you can definitely check that out if you're interested and kind of get a good understanding of what my thesis, my opinion is, and which ones are my favorite among those 5s. But CrowdStrike, 2023 is expected for them to also turn the corner towards profitability. And if they can do that, then this is, again, it's going to be at the top of my list for looking into, for potentially buying the cybersecurity sector. Share dilution still a bit concerning for the company. They have been consistently increasing shares from 199 closer to 200 million to now over 230 million, which I guess is not a lot, but we definitely want to see the company either pause or not issue shares anymore or consistently buy back shares, which I think is going to be more important. So which drives which, yields versus market? So yields are driven, of course, with expectations on inflation and interest rates, which in turn drives the valuation for markets, and of course, equity returns and the discount rate, which drives prices. So I would say like it's the economy that drives the yields, which drives the equity markets. So 67%, 2/3 of people expecting the Federal Reserve Chairman Jerome Powell to be extremely hawkish today. In now under 8 minutes is when we get that speech. So be ready. Share this live stream if you want with other people who might be interested in watching Jerome Powell live. We'll do an audio test as soon as this begins. And then we'll just listen in on what he has to say. Coverage begins at 10 a.m. Should be interesting. Excited. Yeah, so Steve, you've already covered NE. We already talked about it, so you can kind of go back and check out the analysis on that stock and then kind of jump forward. Tesla down 1.5%. That's good. Keep dropping. Keep coming down. 185 is... I'm just kidding. I'm kidding. I'm not rooting for Tesla to come down. It's just be nice. We'll be able to buy more, right? Calvin's going to make fun of me now. Thanks for staying up past your bedtime. Come on. My bedtime is not 8:30 p.m. Come on, Kevin. It's not 8:30 p.m. I don't sleep that early. It's 9 p.m. Let it drop. I want to buy it around 145, Chris says. Yes, those would be nice prices on Tesla for sure. Volatility is pretty subdued here. We'll see what happens when Jerome Powell starts talking. So far, energy has been a big underperformer on the year. So this is going to be the entire breakdown of, all the sectors put together. The 10-year yield is kind of leading the way now. It is up 5.5%, but then it's still down relative to what other stocks are doing and other assets are doing. So Bitcoin's up 32%, 34%. We got Ethereum up 28%. We got, mining's ETF 15%, XLK, which is tech, up 14.5%. Nasdaq's up 13.6%. Discretionary is up 13.3%. We got communication services, defense, and aerospace, biotech. A lot of them are up on the year. Volatility is down. Silver is down. Utilities down. We got healthcare and staples also pulling back. So very much risk-off sectors, defensive sectors, struggling so far on the year. 901. So HYMC, let's see what that stock is. Highcroft Mining Holding Corporation. Wow. So yeah, I mean, this is like a penny stock. So I mean, 71 million market cap. Not really something that we'd be interested in. Because it's a really low market cap, right? I mean, small market cap companies like micro cap, there's nothing wrong with them, right? Companies got to start somewhere when they go public. But it's just that in the public markets, they're very easily manipulated, right? I mean, you could have, a big hedge fund, a big institutional fund come in, or like a big player come in and just like literally move that stock with the volume that they have, and becomes very easily manipulated. So I try to kind of stay away from those types of companies. And two things I really look for is the market cap and the volume. And I've even seen like companies that have over $1 billion in market cap, but then they're really, really illiquid, right? They've got shares traded in the 100,000 shares, per day range. So those are very illiquid in nature, and that's why the spreads will be higher. It'll be much difficult for you to kind of get in and out of those trades. So I also stay away from those. So two basic thresholds that I like to follow are $1 billion and over in market cap, and at least 1 million shares traded per day, right, on average. So those are the two main minimum thresholds that I look for. So new overview update design on TradingView. I don't see a new update. I mean, it's been changing over time for sure. I mean, when I first got started 5 years ago, TradingView was completely different to what it is now. So yeah, I mean, it feels a lot better over time, but I can't remember if there's been any changes recently for TradingView. But yeah, I mean, whatever they're doing, just keep doing it. They're one of my favorite companies, so I really like them a lot. Okay, so what do we got? We got about 2 minutes. 2 minutes, folks, we've got, and should be interesting. What I'm going to do is I'm going to pop this out, close this one in, make that this big, and we're going to scroll in on here. And boom, perfect. So we've got everything on screen, right? So we'll be able to watch and listen. As soon as it starts, I will kind of do an audio check just to make sure the audio is coming in good. And you guys can see that, obviously. And we'll keep switching between, the S&P. We'll put the S&P over here. I'll put the NASDAQ over here, see how the market's reacting to what Jay Powell has to say. And the poll looks like it's going to finish in with mostly hawkish, but make sure that you do still vote. We're at 325 votes only. Come on. If you can get up to 600 votes, vote right now. Vote. I want to know, hawkish or dovish for today. What are we feeling? I do think after the inflation print that we saw, especially on the PCE and core PCE, I feel like he can lean a little bit more towards the hawkish side. I think he also does believe that every time he gives even the smallest clues that he is slightly dovish and talks about disinflation, the market takes that as a huge positive and rallies, and that's the last thing that he wants. So I think he might be leaned a little bit more towards the hawkish side. So I am more towards the 67% that have voted for hawkish because of what those PCE numbers came in as, a little bit more on the hot side. 30 seconds, folks. And again, I'm going to do an audio check. So I'll turn this microphone off. I'll turn this one on. And then you just let me know if the audio is good in the live chat, giving me a thumbs up. And then we'll just listen in. Market's already starting to make a move lower. Nasdaq's now down on the day, 0.1%. S&P is down 22 basis points already, huh? All right, any day now, any day. Oof, that's a pretty wild move lower here. In terms of economic data, like what do we had? Wholesale inventories, that's about it. 10 a.m. And then it's only Jerome Powell that he's supposed to start talking. Well, this event's supposed to start here. But man, that's a red candle. Brutal. Tesla now in the 180s, 188 down 2.5%, with Google down 0.5%, and Apple also really rolling over with Microsoft pulling back. Yeah, still hasn't started. I'm literally on their website right now, live hearing. Bashar Saroof, he'll be dovish. I don't think so. I don't think so, brother. I think after the inflation print that we got in January, PC numbers came in a little bit hotter. So that's the only thing I'm concerned about after getting a spike here. I mean, the problem is not so much month over month, but the fact that year over year we went from 6.4 to 6.5. We kind of ticked up. CPI, PPI, they both still were lower, even though month over month we were down, but it was a PCE, which is the Fed's preferred measure of inflation. That coming in hotter a little bit, year over year ticking up, just kind of stabilizes that move lower, right? There was a lot of momentum down, and then it stabilized and ticked up. That's a bit of a problem. Now, Jerome Powell has been talking about how, and I know exactly what he's going to talk about. He's going to say, "Oh, those are seasonality trends." So that's more like seasonal. But we'll see if February numbers come in as hot as January. Oh, come on. What is going on here? Nothing in this world starts on time. I know. Coverage begins momentarily. Oh, I hear something. Okay, good. All right, I'm going to do an audio check here. So let me know if you guys can hear this.
Seeming to enjoy it when you come to our committee. Thank you. Seeming to enjoy it. Today we examine the Fed's actions to combat inflation and whether these actions are actually working, including how those actions affect American jobs and their paychecks. Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices while reporting record profit increases quarter after quarter and doing more and more stock buybacks. It's the people working hourly jobs to make ends meet. It's seniors on fixed income and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most if the Fed's actions to curb inflation go too far. No matter what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up. Workers are left paying the price. As you've noted, Chair Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies just have to raise prices. Their costs are going up. The workers just want to be paid too much. They have no other choice, they tell us. Yet when you look at their profits and their executive salaries and their stock buyback plans, it sure doesn't look like corporations have exhausted every available alternative. It's so brazen. Even global bankers called on the Fed to identify this profiteering is one of the biggest drivers of inflation. Paul Donovan, chief economist of Global Wealth Management at UBS, wrote, "The Fed should make clear that raising profit margins are spurring inflation. Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures." Think about that. From a chief economist at UBS, I'll say it again, these companies have taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures, unquote. Understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course, there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poor, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one third of its workforce in the last 10 years. Then you're surprised with these derailments? It's the same reason corporations now keep prices high, even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that. I know that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that haven't seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Senator Scott. Sorry.
Sorry. Good morning, Jerome Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next nom that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every question, every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion, and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income, whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle. I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so
With a sense of humor.
with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes, sir.
I
Thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy in the state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine, won't get better because of interest rate increases. Every indication is that this post-pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war, which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect, but there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, in our conversations in the past show my concern about continued rate increases that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking system. My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
as quickly as possible.
Yes, but it will be some months.
Okay, thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders, always defended by people on that side of the aisle, into stock buybacks, which makes me concerned that there's a downturn in the economy. Banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk. Lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the, with the whole crypto space, and that they give us prior notice. And we've issued, along with the FDIC and the OCC, a number of issuances of notices to that effect.
Thank you, and I will close with this. I've long pushed for the Fed to prioritize workers and for the leaders of the Fed to reflect the diversity of our country. We've made progress, but our work is not done. We have a new opening. Understand, it's not your job to appoint the new Fed member. We have a number of upcoming vacancies at the Reserve Banks. I support Senator Reid from Rhode Island, Senator Menendez from New Jersey, and other colleagues who are pushing for more diverse voices at the Fed. Senator Scott.
Thank you, Chairman. Obviously, the chairman and I both have strong passions about the challenges that we face as a country. The one thing that I do believe that we agree on is the importance of having a strong capital markets as it relates to making sure that Americans have the ability to continue to grow their businesses and to solve their challenges. And frankly, I hope that we get there. Building on the same comment that Chairman had around capital standards is where I'm going to go with my thoughts today. When I think back on these last few years, it's hard not to recognize the extraordinary efforts our financial institutions of all sizes, frankly, undertook to administer a program like the PPP, all while weathering a shutdown of our global economy. I welcome your thoughts, but from my viewpoint, our banking system was resilient. Our financial institutions stepped up and delivered aid to support families and businesses every single day. That's why Vice Chair Barr's broad comments around holistic review of our capital trouble me so much. We should be laser focused on our economy and addressing the needs of everyday Americans trying to forge a new future and helping them open the door to opportunity. As you and I both know, capital and its quality must be continually scrutinized, but increased capital does not necessarily provide an increased benefit, and requiring banks to hold capital that is not risk-based and appropriately tailored to a bank's size, scope, and activities can cause more harm than good. At a time of record inflation, where everyday needs are more expensive, we should not be pursuing actions that are harmful. Rather, we should be supporting the engine of our economy, small businesses. While I remain greatly concerned by the Vice Chair's comments, I am hopeful that you will ensure this review is appropriate, keeping the impacts on our banking system front and center. We must promote and further the growth of our economy and thereby our people. Anything less should be unacceptable. To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all?
Yes, I can easily commit to that. We're very strongly committed to tailoring, and that'll be, I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much. 2 weeks ago, I sent a letter with Chairman McHenry to Chair Gensler regarding the SEC's climate disclosure rule, urging him to rescind his proposal and reminding him that the SEC is a market regulator, not a climate forecaster. Much like Congress designed the SEC to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation, and not to advance progressive climate change policies, Congress designed the Federal Reserve to promote price stability and maximum employment, not to play politics. To that end, I find worrying the Fed's announcement of recent actions to consider climate-related scenarios, coupled with remarks by the Vice Chair of Supervision, as attempts to incorporate broader ESG policies into the financial services system. Banks have and continue to account for weather-related risks in their risk management, but efforts that attempt to predict climate change far into the future fall outside the scope of their authority. Importantly, the level of speculation required in these models should highlight their arbitrary and capricious nature. At a time when our economy is suffering from historically high inflation, I expect our central bank to focus its time and resources on bringing inflation down, not on policy outside of its mandate. I noted in my opening statement a recent speech that you've given about the state of the Fed and how you should resist the temptation to broaden its scope and to address social issues. Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have that I believe that we have, but I would agree with your statement.
Yeah. Mr. Chairman, I have 20 seconds left, but I'm going to defer because of my earlier question to my opening statement.
Thank you, Senator Scott. Senator Menendez is close, but not here yet. So, Senator Rounds. Okay. So, but nice try.
Yes, sir. Just want to make sure whatever you say.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome. It's always good to have you in front of our committee. And as you know, both core and headline inflation have remained persistently elevated. And over the past 12 months, real average hourly earnings fell by 1.8%, about 4% since President Biden took office. To make ends meet as prices increase, more Americans are leaning on credit cards. At the end of 2022, credit card debt hit a record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. As we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy is promoting higher prices with regard to energy, as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you, and the limited number of tools that you have are designed to impact simply the reduction in prices and so forth, and yet if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy induced or whether it is a matter of a shortage in supplies from outside or whether it's war related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words, and by that, I'm just going to look at energy alone just as a good example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense, it is, but I would just say on energy, I'm
not trying to get you to a policy discussion with what the president's doing on his energy policy. I just want to make it clear that you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's driving it up. You're simply trying to bring it back down to that 2% number with the only tools that you've really got.
Yes, but I will say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
And I think just the fact that you've been increasing you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Thanks, Senator Rounds. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I want to take this moment to remind my colleagues that there are more than 62 million Latinos that call the United States home. We are the largest minority group in the country. We account for nearly 20% of the United States population. We contribute almost $3 trillion in GDP. Yet Latinos have no representation in the Federal Reserve's leadership. In the 109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors. It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate, who will preserve the independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice, and I hope the administration makes the right choice with this nomination. Mr. Chairman, would you say that it is a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of deja vu because, once again, Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. If you want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse. and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee, is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue too, but it's principally rate hikes.
So the question is, when does that part of doing anything necessary to tame to tame inflation, come into conflict with your other mandate of maximum employment?
Not now, when we have the lowest unemployment in 54 years, and where we have a labor market that is extremely tight, extremely. So, but that time could come, but it really isn't now, where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so, if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of.
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the
Okay.
Fed has tried to reduce inflation.
Now, right now, the current inflation rate's 6.4% and the current unemployment rate's 3.4%. Now, if history is right, I'm not asking you to again blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay, and to get inflation down to 2.2%, based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in
I
play
mean,
here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Okay.
Sir?
It could work out that way.
Yes, sir. Thank you.
Thank you, Senator Kennedy. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman Powell, for being here today. We saw in the wake of COVID the globalized supply chain disrupted significantly, and we're in the process, in some respects, of rebuilding a supply chain with an emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector, that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. You know, our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional. Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and the CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say, we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
We've gone back and forth on the impact of rate hikes on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without a softening in the labor market, without a rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned.
Right.
So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thanks, Senator Reid. Senator Brett, Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's great to have you here today. Over the past 2 years, we've seen the highest inflation of my lifetime, driving up costs for American families across the board. According to the U.S. Department of Labor, the annual inflation rate in 2021 was 7%, and in 2022, it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022. And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the 3 sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by, really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs,
Yes.
that would be great because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game, but it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will at the margin provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
And I know out of respect for the chairman and trying to stay in my time, I will just end by saying I heard what you said. Obviously, as you have said, the Federal Reserve is not and will not be a climate policymaker. I just want to thank you for your public statement on that. I agree with you that there's a difference between policymakers and financial regulators, and certainly look forward to working with you in the future.
Thanks, Senator Britt. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Let me start by saying, depending on who's asking questions, we're either pounding you for how quickly we're going to drive that inflation back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net. We've still got ways to go, and the January numbers were concerning. But I do think your tailored approach, we can all second guess, but I think it has been the right approach. I'm going to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing, we're going to hit a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition. And I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side. And I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in nature. And how are you thinking about that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP. So you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we're well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? it's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small size banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring, and I'd say we're on the case. So,
Well, that will morph me into my last question, something we've talked about and a lot of my colleagues have talked about with the large institutions. I mean, I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and was able to withstand COVID in a very healthy way. But what we've also seen evolve is a vast amount of financial institutions move beyond the regulatory perimeter. The fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that that we ought to look less at charter and look at same risk, same regulation, maybe as a guiding principle. And I know Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to, when they deal with something that looks like a money market fund, that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right. So much of intermediation has moved away from the regulated banks really for a long period of time. We got to keep an eye on that.
Thank you, Chair Powell.
We can keep looking at it. I hope it's.
Thank you, Senator Vance. I'm sorry, Senator Hagerty of Tennessee.
Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020, it was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you told this committee that our financial system has proven resilient through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. That's what the former one, Vice Chair Quarles did, and that's Dan Tarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's general counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized or made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring. And anything we do is going to reflect, tailoring of institutions according to their risk. And I mean, that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So core inflation is running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Mm-hmm. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think that the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
Senator Warren of Massachusetts.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly, all of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very,
Just
very
looking at the
infrequent.
numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this.
There have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families. And if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's slightly far afield, but how often do you get to talk to the Federal Reserve Chairman, so I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly, my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region. And consequently, you have lower productivity growth, lower innovation in an economy that's much less diversified and much less dynamic. I'm wondering, when I hear about the history, when I think about and read about the history of Appalachia and the resource curse, I'm struck by some of by the idea that you could make a similar argument about the reserve currency status of the United States dollar. Americans have enjoyed one of the greatest privileges of the international economy for the last nearly 8 decades, a strong dollar that acts, of course, as the world's reserve currency. You know that better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, today. Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used in all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world, mostly with dollars. That's an advantage. There's some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But, the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially what we try to control is price stability. And no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on. Matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Thank you, Chairman Powell.
Thank you, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here and for your service. I know the Fed is experiencing lots of challenges these days. I've got a couple questions that are just, I think, basic yes or no's, and then some longer questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Yes.
Right. Now, recently, we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the employment cost index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that the overall, all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
Right. I think the larger point here, based on your response to that first question about growth in profits, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes. I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up. As the supply chains get fixed and shortages are alleviated, you will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right, but profits are the margin, right? They're going up beyond what they were before. That means that even with the increase of costs because of supply chains, they're making more profits. Which again, that they can do that. But my point is that as a contributor to inflation, as you indicated in response to the first question, let me ask you about the tight labor market because one of the issues in a tight labor market is parents with kids, including a lot of moms who would like to go back into the market, but are not able to do so because of lack of affordable childcare. The other issue is immigration, and I know that you've gotten some recent data on how some immigration figures actually have softened a little bit the tightness in the labor market. Can you just talk broadly about those two factors, affordable childcare and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation pressures?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's childcare available, which is, I think, kind of self-evident. The second was
impact of immigration.
Yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000. And a significant part of that has been immigration. And that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2021 and 22 may be alleviating. So that would contribute to that. Clearly, more people. Clearly, the economy is calling for more people with essentially two job openings for every unemployed person, and this can be a source of those people.
Right, and that would reduce the tightness of the labor market and reduce pressures on inflation, right?
May already be doing so.
Thank you.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I can't resist responding to a few things that my friends on the left have said. For example, in his opening statement, Chairman Brown had a long list of things that raising interest rates won't do. Raising interest rates won't fill in the blank. I'm going to fill in the blank with a couple things. How about raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending, overborrowing, overregulating? Chairman Brown said we should rebuild our supply chain by curbing offshoring, corporate offshoring. I agree. He talked a lot about corporate greed contributing to inflation. Okay. But how about regulatory greed contributing to corporate greed? How do you expect corporations to reinvest money if you overregulate their ability to invest that money right here in the United States of America? You want to onshore some things? How about energy policy? How about instead of looking to Venezuela or Iran for oil supply, or Russia, or rather than looking to China for electric vehicles and chips and solar panels, how about we have a strategy that onshores those things by reducing regulation, reducing taxes, and letting those corporations reinvest their profits rather than stock buybacks or dividends. This idea that somehow the Federal Reserve is supposed to keep inflation in check while half of the government works against it is mind-boggling. Now, I know, Mr. Chairman, you don't like to comment on policy. You and I have been around and round about this. You were anxious to advise us to spend lots of money during the pandemic. I don't think a lot of people blame you for that. You wouldn't respond to efforts by the Biden administration after we were in a robust recovery from not spending so much money. Okay, I can appreciate the change. But now we're in this debate between Republicans and Democrats, between particularly the House Speaker and the President, on how to raise the debt ceiling. And you've made some pretty strong comments about raising the debt ceiling, absent from structural reforms that would actually help us get back to a reasonable growth. So I warn you again, if you're going to make political comments, if you're going to advise us on policy, be consistent with it. Now, I want to get back to the greening of the Federal Reserve and these I call them stress tests. You can call them whatever we call them. But I'm concerned that now the Federal Reserve is starting down this path. Maybe it's slightly at first about climate stress testing. I just want to ask you this. If we're going to go down that path, if the Federal Reserve is now going to become part of the Federal Climate Police Force, are we going to consider the ramifications of having entire communities and economies, factories and manufacturers, whatever, energy entities, large server farms, leaving them susceptible to a very unreliable, very expensive energy source? Is that part of the stress test?
No, those are considerations for elected people, not for us. We have a narrow role to play here, but it's a real role, and I can talk about that if you'd like.
Well, yeah, I would like you to, because again, if we're gonna start doing stress tests for the 6 largest financial institutions related to climate, which really is more weather than climate, then are we going to consider the effects of an unreliable energy source at several locations throughout our country?
So our only focus is on the safety and soundness of these institutions, and do they understand and can they manage all of the risks that they run in their business model. That's our only goal. We're not looking to be climate policymakers. Climate policy is clearly going to have effects on regions, on companies, on individuals, on countries, disparate effects. That is not for.
All right, everyone. So I'm actually going to be calling it here for the live stream. I'm going to be sharing the link to this speech over on Discord. If anybody wants to continue watching, it's going to go on for another 30 minutes. But again, the live stream here, thank you so much for joining. And as always, happy investing. Drop that like button, subscribe, and I'll see you all in tomorrow's live stream when Jerome Powell once again speaks in front of the U.S. House of Financial Services. Thank you so much for being here. Take care.